The legend of Joseph Kennedy usually focuses on a single anecdote. It is the story of the shoeshine boy. The story goes that on a crisp morning in the winter of 1929, Kennedy was walking down Wall Street. He stopped to get his shoes shined. The boy polishing his boots, a kid who probably didn't have 2 nickels to rub together, looked up at Kennedy with a gleam in his eye. The boy said, "Mr. Kennedy, you have to buy Hindenburg oil. It's a sure thing. I bought some yesterday and it's going to the moon." Kennedy smiled, tipped the boy, and walked away. But as he walked to his office, a cold realization washed over him. He realized that the market operates on the greater fool theory. You buy a stock not because it is worth the price, but because you think you can sell it to someone else for a higher price. But for the market to keep going up, you need a constant stream of new buyers. You need fresh money entering the system. Kennedy realized that if the shoeshine boy, the person at the very bottom of the economic ladder, the person with the least amount of capital and the least amount of information, was fully invested in the market, then there was nobody left to buy. The pool of greater fools had run dry. The saturation was 100%. He realized that when the taxi drivers and the shoeshine boys are giving stock tips to the bankers, the cycle has inverted. The smart money had already sold, and the dumb money was holding the bag. Now, this is a great story. It highlights the psychology of a bubble. But Joseph Kennedy was a man of numbers, not just anecdotes. He didn't sell his fortune because of a shoeshine boy. That was just the emotional confirmation of a technical reality he had been tracking for months. And the real signal, the one that connects directly to 2026, was brokers' loans. In 1929, you didn't need to pay full price for a stock. You could buy on margin. You could put down 10% of your own money and borrow 90% from your broker. If you had $10, you could buy $100 worth of Ford Motors. If Ford Motors went up 10% to $110, you doubled your money. You made a 100% return on your $10 investment. This leverage was the drug that fueled the roaring 20s. It made everyone feel like a genius. But leverage cuts both ways. Kennedy looked at the data for brokers' loans. This was the total amount of money borrowed to buy stocks. In 1927, it was around $3 billion. By 1929, it had exploded to over $8 billion. The entire stock market was floating on an ocean of debt. The prices weren't real. They were inflated by borrowed money that had to be paid back with interest. Kennedy understood the mechanics of a margin call. If a stock you bought on margin drops just 10%, your entire equity is wiped out. The broker will call you and demand more cash immediately. If you don't have the cash, the broker sells your stock instantly at the market price to recover their loan. Kennedy realized that with $8 billion of margin debt in the system, a small decline wouldn't just be a correction. It would be a nuclear chain reaction. If prices dropped, it would trigger margin calls. Those forced sales would drive prices down further, which would trigger more margin calls for the next group of investors, which would drive prices down further. It was a mathematical inevitability. The market had become a house of cards soaked in gasoline, and everyone was playing with matches. So, what did Kennedy do? This is the core of the Kennedy strategy, and it is the hardest part for any investor to execute. He sold early. In the summer of 1929, while the market was still roaring, while his friends were still making fortunes every single day, Joseph Kennedy started selling. He liquidated his long positions. He sold his movie studios. He sold his tech stocks. He moved everything into cash and safe government bonds. And this sounds easy in hindsight, but in the moment, it is excruciating. Imagine selling your Nvidia or Bitcoin today, and then watching it go up another 20% next month. You look like an idiot. Our friends laugh at you. You feel the fear of missing out, FOMO, gnawing at your gut. Kennedy faced all of this. He was criticized. He was called a bear. He was called out of touch. But he had the discipline to ignore the noise and trust the signal. He knew that only a fool holds out for the top dollar. He was content to leave the last 10% of gains for the suckers in exchange for keeping the first 90% of his fortune.